Hello everyone, welcome back to the channel. In today's video, we're going to talk about one of the most powerful tools in financial analysis, financial ratios. You may understand the income statement. You may understand the balance sheet. You may even understand the cash flow statement. But the real question is, how do we interpret all those numbers? That's where financial ratios come in. In this video, I'll explain what financial ratios are, why they matter, the major categories of ratios, and how they are used in real-world IFRS financial analysis. Let's get started. What are financial ratios? Financial ratios are relationships between numbers in financial statements. They help us answer questions like, is the company profitable? Can it pay its debts? Is it efficient? Is it attractive to investors? Instead of looking at raw numbers like, revenue is 5 billion, profit is 800 million, ratios convert those numbers into meaningful relationships. For example, if profit is 800 million and revenue is 5 billion, we calculate profit margin. That tells us how much profit is earned from each unit of revenue. So financial ratios turn accounting data into decision-making tools. Why financial ratios are important? Under IFRS, companies publish standardized financial statements. But investors, lenders, and analysts don't just read them, they analyze them. Financial ratios help. Investors decide whether to buy shares. Banks decide whether to give loans. Managers evaluate performance. Competitors compare performance. Auditors assess financial health. Without ratios, financial statements are just numbers. With ratios, they become insights. Main categories of financial ratios. Financial ratios are generally grouped into 5 major categories: liquidity ratios, profitability ratios, efficiency ratios, leverage ratios, market ratios. Let's break them down. Liquidity ratios. Liquidity ratios measure a company's ability to meet short-term obligations. They answer, can this company pay its bills on time? 2 key liquidity ratios. 1. Current ratio. Current assets divided by current liabilities. If the ratio is 2 to 1, it means the company has twice as many short-term assets as short-term liabilities. 2. Quick ratio, acid test ratio. Current assets minus inventory divided by current liabilities. This is stricter because inventory may not be easily converted into cash. Under IFRS, these figures come directly from the statement of financial position. B. Profitability ratios. Profitability ratios measure how well a company generates profit. They answer, is the business actually making money efficiently? Key examples. 1. Gross profit margin. Gross profit divided by revenue. This shows how efficiently the company manages production costs. 2. Net profit margin. Net profit divided by revenue. This tells us how much profit remains after all expenses. 3. Return on assets. Net profit divided by total assets. This shows how efficiently assets generate profit. 4. Return on equity. Net profit divided by shareholders' equity. This shows how effectively management uses owners' funds. Under IFRS, profit figures come from the income statement, and assets/equity come from the balance sheet. C. Efficiency ratios, activity ratios. Efficiency ratios measure how well the company uses its assets. They answer, is management using resources properly? Examples. 1. Inventory turnover. Cost of sales divided by average inventory. This shows how many times inventory is sold during the period. 2. Receivables turnover. Revenue divided by average trade receivables. This shows how quickly customers pay. High efficiency usually means strong operational performance. D. Leverage ratios, solvency ratios. Leverage ratios measure long-term financial stability. They answer, how much debt does the company use? Examples. 1. Debt-to-equity ratio. Total liabilities divided by shareholders' equity. A high ratio means the company relies heavily on debt financing. 2. Interest coverage ratio. Profit before interest and tax divided by finance cost. This shows whether the company can comfortably pay interest on its debt. Under IFRS, these figures are clearly disclosed in financial statements and notes. E. Market ratios. These ratios are mainly for publicly traded companies. They help investors evaluate share performance. Examples. 1. Earnings per share. Profit attributable to shareholders divided by number of shares. 2. Price to earnings ratio, P/E ratio. Market price per share divided by EPS. IFRS specifically requires companies to disclose EPS in the financial statements. 4. Important principles when using ratios. Financial ratios are powerful, but they must be used properly. 3 key rules. Compare over time. One ratio alone means little. Compare this year to last year. Compare with industry averages. A good ratio in one industry may be bad in another. Use multiple ratios together. Never rely on just one ratio. Ratios tell a story, but only when interpreted correctly. 5. Conclusion. So to summarize, financial ratios transform financial statements into meaningful insights. They help assess liquidity, profitability, efficiency, leverage, and market performance. If you truly want to understand financial statements under IFRS, you must understand financial ratios. Because accounting is not just about preparing reports. It's about interpreting them. If you found this helpful, don't forget to like, subscribe, and share this video. And in the next video, we'll take practical examples and calculate real financial ratios step by step. See you in the next class.